Joining us right now, Gene Munster, managing partner of Deepwater Asset Management. Is the knife just going to continue to fall here, Gene? At what point do you say there's value, and what point do you say we got a lot more wood to chop?
It's more of the latter, and of course, when the Fed Chairman Powell had the comments a few weeks ago, the view on that was optimistic, even though he reminded us it's all about the data. We're getting some of that data today. And the reason why I think there is more wood to chop here is that ultimately there's another vector that I don't think is talked about as often around this inflation number. Fed talks about it a lot, but is the unemployment number. This has a unique impact on tech stocks. Unemployment, let's call it 3.5%. Historically, that is the most entrenched piece of the inflation number is wages. People get raises. It's rare that they want to give up those wage increases. And so to get to that 5 or 6%, unfortunately, it's disappointing to say it, but it's probably 2 to 4 million jobs need to be kind of released from the economy here to get that down. Well, in other words,
let me ask you about that, though, because I just asked Loretta Mester about that very question, which is basically, can you actually lower inflation and do that without increasing job losses? She seemed to indicate that she thought there was a way to land the plane and, do two things at the same time. I don't know. It sounds like you think you don't believe it.
Historically, that's been the most entrenched piece of inflation. I just think from a psychological perspective, you think about the two levers of inflation. One is prices, companies raising prices because of higher input costs, but they can change those prices, I think, more quickly than a person wants to give up wage increases. The way you essentially do it, people don't take pay cuts. They really do that. Essentially, jobs get released. So my sense is that just psychologically, this is the most difficult part, and I think historically this has been the case. Of course, the backdrop of the strong economy and the tight jobs market would lend to the belief that that doesn't have to happen. But we are in the camp that that does need to happen, and I think if we play this forward to think about tech and what the impact is on rates, unfortunately, it's not good news. And
so play it out. Play it out. Where are we this summer? Where are we this summer? Where are we this fall? What does the economy look like? Where do these tech stocks look like?
I'll look at it kind of in the first half of the year and then the back half of the year. And I think the first half of the year is that we're going to continue to see inflation not going down at the pace that people want. And I think rates remaining higher for longer. Of course, that has a negative impact on the most risk assets, which, of course, is tech. And so my sense is that, this is going to go, these are going to go lower. We're a growth investment firm. We focus on tech. We have a product that is 50% in cash still. We didn't play the rally in January, and we're not really deploying on these pullbacks right now. And so I think that the big piece is near term. If you have the benefit and the opportunity to time the market, I think it goes lower. And to
goes lower. So we're looking at chip makers right now. Look, everything's down. Twilio down to 2.3% right now. Got Adobe off 5%. That's after the Figma deal seems to be now in jeopardy. Snowflake off 3%. At some point, do you just? I mean, the real question. A lot of people say, "Oh, if you own this stuff, hold it." Do you hold it? Do you sell it if you think the knife is falling?
Unfortunately, it depends on the perspective. If you're an investor,
what's yours?
Our perspective is we have a fund that's 50% in cash right now for investors who want exposure to timing of the market.
What do you?